The credit score from a derogatory perspective is predicated on recency. I had a $1,000 bill reported from January of 2020. I pay it in full now, 5 years late. The algorithm is going to see that $0 balance now and look at it as if it's a brand new collection. So when we tell our borrowers a collection is a collection is a collection, a $10,000 collection and a $0 collection reported in the same month adversely affect the credit score at the same exact rate.
So you mean to tell me if I pay the $10,000 collection debt down to zero, or even if I pay the $100 collection debt down to zero, regardless, you're still going to get a negative impact. Regardless, so it doesn't matter about the weight of the debt. No, it's just the fact of how the algorithm reads the recency.
It's a collection.
Wow. Welcome back, everybody, to another episode of Homeschool, where we talk everything home buying. I am your host, Carlton Pucket, and I have the lovely
Mary D. Bryant.
And we have a special guest with us today. We have Mr. Anthony Iacobucci.
Hey, everyone. My name is Anthony Iacobucci. I'm the National Director over at Uqual, a fintech platform specializing in home loan readiness.
Fantastic. Thank you for being with us today.
I appreciate the opportunity to sit down with you guys.
Absolutely. We have a lot of questions that we want to get through today for our first-time home buyers, our repeat buyers, but definitely the mortgage platform in regards to credit.
Yes. Yeah. There's tons of information out there that I look forward to hopefully dispel with you guys and give you guys some really good information of really what's going on in the market in regards to credit.
So if you could break it down and just really tell us, what is it the most simplistic way you could describe it, exactly what it is that you do?
You know, the home buying process oftentimes becomes quite daunting to the first-time home buyer. There's so many things, so many boxes you need to check. Our platform, our fintech platform, allows a consumer to simultaneously address, quite frankly, some pain points that loan officers feel in the pre-approval journey. For example, credit is really tip of spear of the platform. We help consumers with DTI, debt utilization. We help the consumers with gathering documents, our documentation procurement. And lastly, we help with helping the consumer budget. Budgeting is such a huge part of the process nowadays, and the platform will do everything simultaneously in obviously conjunction with the loan officer and make sure that we're getting the consumer to a precipice so that they are pre-approved.
With that being said, are all of the only clients that you deal with, are they all just potential homeowners, or do you deal with all different types of clientele?
You know, I'd say about 95% of our clients are in the midst of the home buying process or refinance. You know, we have a small chunk, about 5%, that are friends and family, word of mouth, but usually every single person that is entering the Uqual journey, entering, quite frankly, the ecosystem that encompasses the entire platform, is in the midst of the home buying process.
So what are some of the key areas that you look at when you are trying to help someone get prepared and pre-approved to purchase for a mortgage?
Sure. So when we're sitting down with some of our consumers and really dissecting, where they are at that moment in time from a loan readiness perspective, again, we're touching upon credit, DTI, budgeting, all the documentation that you guys are going to need here at loanDepot. I think the great thing that we have the ability to do is really hone in specifically, what can be achieved, in the most seamless and efficient fashion. Let's talk about credit for a second. Credit is such a mystery nowadays. And quite frankly, in my opinion, the first base of a transaction is, do I have that 620, 640 that you guys are looking for? Our ability to kind of diagnose a consumer's maybe pain points that he or she has, do it from a credit perspective, I think, we're the best in the business at doing it. And now our technology piece is revolutionary, that has the ability to really optimize a consumer's credit, obviously to get them back to you guys as quickly as you possibly can.
So I think one of the first things let's dive into are maybe some of the basic things about credit and getting pre-approved to purchase. And the first thing that we typically look at is the credit report. And so when we pull a credit report, there are 3 bureaus that we pull from: Equifax, Experian, and TransUnion. And from that, the question that I typically get is, I had either Credit Karma or with my bank or my credit card, I was given a score. And so why is the credit report score that you're giving me different than the one that is actually my bank or my credit card has given?
Wow. There's a one-word answer for that, and it's algorithm. There's various mathematical equations that are approved by the federal government, Fannie and Freddie, specific for mortgage lending.
Okay.
Unfortunately, we're living in a world of disinformation or misinformation, and there's various of other outlets to pull your credit. But you need to have an NMLS number to get access to what Fannie and Freddie are going to deem the correct algorithm to compute your mortgage credit score. And quite frankly, as you both know, it's heavily scrutinized. You're on the hook for hundreds of thousands of dollars, upwards to 30 years sometimes. So nowadays, I think a consumer really needs to take the plunge and sit down with a trusted loan officer at loanDepot and really dive into the true depiction of where they're at from a credit perspective. Because nowadays there's too much information out there for them to obtain that's really setting false hope, that's setting a false narrative of where that they might be in the process.
Now, let me ask this question. Something majority that our audience will want to know. When they're looking at paying all their bills on time, all the time, and they do everything perfect, why is it that their credit scores are different? Why aren't all the scores the same if they pay all their bills on time all the time?
Sure. It really comes down to the fact that the three credit bureaus, TransUnion, Equifax, and Experian, they have autonomy. They're not in collaboration together. So they're all independent, for-profit, billion-dollar organizations. Oftentimes, they're using different algorithms and having different information to report. The dates could be different. The balances could be different. Sometimes the information is null and void to one credit bureau, and the other two credit bureaus are reporting that information. So really it comes down to the fact that there is no collaboration amongst the three credit bureaus, and oftentimes they are using different algorithms. And I don't want to make it sound too technical, but there's about 54 different mathematical equations that you can use to compute your mortgage credit score. There's 8 predominantly about that you guys will use for the most part, without getting super technical or kind of, blowing the mind of some of your listeners. It's all about just a variation of information that is being pulled at that credit bureau.
Yeah, you definitely got me. You said, my mind.
So since we're diving into that a little bit, what would make someone credit capable in order to be ready to purchase or to refinance and have that mortgage?
Yeah, there's definitely some boxes that we like to check with our consumers, especially when we're counseling them and coaching them and advising them on how do we get back to loanDepot as quickly as we can. At the same part, making sure that everything that we're doing is going to optimize my credit. First and foremost, maintaining low credit card balances. And let me actually jump back. Having a credit card open is vital to the process. 30% of your credit score is predicated on, do you have a credit card open? That's like telling you guys today, I don't have a credit card. I go to take a test. The best score, if I do everything else perfect, the best score I can get today is 70%. And I know that, I don't want to go back to 08, 09, but a lot of people in the last 10, 15 years have been apprehensive to reestablish credit. They've leveraged themselves. They don't want to get back to the point in which they were because they got there through, having too many credit cards open. The beauty about the algorithm approved by the federal government is this. There's no wealth bias in credit score. Just because someone's got more liquidity or cash flow and they can afford a $30,000 limit doesn't mean that he or she gets more points. So getting a small $200-$300 credit card to manage over a 4 to 6 month time period optimizes that 30% of the pie that's allocated towards having a credit card open.
Well, let me ask this. What about that person that may have, perfect example, I actually have an auntie who she has her own car note and then she co-signed for both of her kids. So now you figure she has anywhere between 30, 40, say $90,000 worth of card notes on her credit report now. And all those payments are being made on time along with her credit cards. Does that hurt her or does that help her if she can maintain the payments?
It helps her because I think what you may be alluding to is that the balance limit ratios, which is called debt utilization on your side of the world, that's not part of an installment, i.e. an auto loan or a mortgage, right? It's only in the credit card world. So maintaining those low credit card balances and having your aunt, making those on-time payments, whoever she co-signed for, is a fantastic thing. I think a lot of times people oftentimes think, oh my goodness, I don't want to take on an auto loan because it's going to show a ton of debt, which, without getting into semantics and getting into DTI, I think it's the consumer needs to understand is that the balance to limit ratio is only affecting the revolving debt being a credit card.
So since we're talking about revolving debt, there is misinformation or a misconception that you should either keep your balances at zero or as low as you possibly can, or maybe you could even go to 50% of whatever your limit is on that credit card. And how does that actually affect your score? So that's a question that I get. Yeah. So will you touch on that and let us know?
Yeah, of course. I think it's probably the number one question that we get in correspondence with our mortgage professionals at loanDepot. Where is that sweet spot? Because once the consumer has established credit, you've checked the first box. Yeah. But the second is, where do we need to maintain those balances to optimize our credit? In my tenure of doing this, I've heard 30%, 50%, I've heard zeros. Yeah. The sweet spot, and it is not cumulative, which is great, but per card, you want to keep that balance at or below 6%. 6%? 6% is the sweet spot.
Wow. Okay.
I thought it was 20.
I'm not gonna lie. I've been telling people it's 50. I am sorry. Yeah. Anybody I told.
And I think a lot of times we get a little pushback is that borrower that likes to carry $0 balances.
Yeah.
Unfortunately, going back to that wacky term and algorithm, it doesn't like dormancy. So that zero projects dormancy. So if you have a borrower in the process and he or she has credit cards, they make on-time payments, just tell them, keep a little bit of a balance on, $10, $20, $30 month over month. Make sure you're actively using it within that month, making an active payment back. That's where you'd really need to be. But I think I want to leave it with this last note in regards to revolving debt. There might be some borrowers that are watching this right now thinking, man, I've got a $300 credit card that might be maxed out, and I've got a $10,000 credit card maxed out. I don't want to pay the $10,000 card down to 6% because what am I going to waive bye-bye to? My down payment. Yeah. That being said, the great thing about the algorithm is everything weighs the same. So attack that $300 credit card, optimize your credit score, and worry about the $10,000 credit card later. So you kind of get the most juice out of the squeeze by paying down the smaller balance. So that's something, again, we're always teaching our loan officers and talking to our clients about is let's optimize opportunity without mitigating anything out of pocket.
So I got one. This is somewhat of a two-part question. So what actually hurts your FICO score? And using your service, what is it that people can do to fix it?
Wow, there's a ton of different things that can affect the credit score. Overutilization of credit cards month over month, derogatory information or questionable accounts, which can range from late payment history, i.e. not paying things on time, medical collections, charge-off accounts, general collections in itself. Anything that is listed in really derogatory status on a credit report has an impact and negatively on your credit score. But there's a ton of different things that a consumer can do, not only to alleviate some of those questionable accounts that have accumulated on the credit report, but getting that debt utilization under control. Length of history is a substantial component of the credit score. That's kind of, we can't make people older. The algorithm likes a longer length of history. The average is supposed to be about 25 years. I don't know how a first-time home buyer might only be 25 years old. So that being said, there's maintaining low credit card balances, maintaining a low inquiry impact. There's a ton of different things that a consumer can do, not only with the guidance from you guys, but just general credit knowledge. Unfortunately, nowadays, this has become foreign to a lot of first-time home buyers. There is not an understanding of how credit works and how financing works. And I think that doing stuff like this, what we're doing right now, is the first step in the right direction to getting the education out there to make first-time home buyers set themselves up for a better qualifying situation.
You did touch on medical collections. I know that is a very hot topic right now, and there have been some changes. Would you elaborate on that?
Yeah, this is kind of hot off the press. So quite frankly, the number one derogatory account or impacting collection account that hits consumer credit report is medical collections. Last numbers I had, it was just a little bit above $88 billion reported at a credit bureau level. In Lux right now, there's about another 49 billion that medical creditors are trying to collect upon. So the Biden administration has just pushed some legislation in collaboration with the CFPB to exonerate all medical collections off consumer credit reports. I've been doing this 14 years. This is going to be the biggest win for consumer credit that I've seen in my tenure of doing this. We're going to see what happens in the next 60 to 90 days, because that's how long it takes the legislation to get pushed. It's not going to expunge the 88 billion that's out there, but it's going to stop that 49 billion that's in lieu right now that potentially could hit the consumer credit report. And it's also going to allow the consumer for the first time to go upon and settle these collection accounts if he or she wants to, and see it getting removed off the credit report. Removing these collection accounts, taking anything from a derogatory and negative status off the credit report, it's always going to, for the most part, increase the consumer credit score.
Something I would love for you to be able to help with our listeners is give them some tips. Like when it comes time for them to buy that new home and they're using your service, do you all cover like things like budgeting or building a savings plan, or maybe just overall strategies for paying off debt? Do you help them with all those different types of things?
We do. Budgeting is such a hot topic nowadays, and consumers are getting pulled in a lot of different directions. Our mortgage-centric platform is powered by AI. What the platform has the ability to do is this, which is fantastic. A consumer has the ability to hook up a debit card predominantly or a credit card where they're using daily transactions. Then the AI has the ability to extrapolate 12 months of transactional history and identify bad behavioral spending. So when we're sitting down with your clients at loanDepot, is it more important for you to get a Frappuccino every single morning and spend $573 a month at Starbucks? Or is it important to cut that out of the budget, allocate it towards your down payment savings to get back to the loanDepot so you have the down payment, so you have the closing costs? Yeah, it identifies some egregious spending, let's say across the board. Starbucks is a big one.
My husband would say, sign me up right now.
I was like, listen, you guys get granular with it.
We do. Yeah. The consumer really has to look themselves in the mirror and say, what is important to me? Is it $1,100 a month in Grubhub fees? Is it frivolous spending on Amazon? Or do I nip this stuff in the bud and check myself, honestly, 3, 4, 5 months to get the credit rectified at the same time I'm going to save for the down payment? We do everything simultaneously, because what we've found historically is that a consumer in a distressed situation that might have some credit issues or budgeting issues or DTI issues, he or she does everything in stages, and it becomes a timely endeavor. And time is the enemy of the first-time home buyer. The market changes. They become disenfranchised with the process, disenchanted with the process. It becomes too long, too cumbersome. What they can do now is the AI takes control of a lot of the heavy lifting for the consumer and helps them budget, helps them with the DTI, helps them with credit. Again, on the back end, the best in the business from coaches and advisors that walk hand in hand with your borrower every single day. But now that every single person that touches our platform has a customary tailored plan to he or she, because it's unique to what their expenditure habits look like, the assets and liabilities off the soft credit pulls that we do internally. We've come night and day from, I was one of the first 10, 15 employees to where we are now. It's bananas. It really is.
So let me ask this, Anthony. First day, customer walks in. What documentation do they need? Because this sounds like you're finding about their spending habits and everything along those lines. So this sounds like you would need like bank statements and things of that nature. What documents would they actually need to bring into you to start a process?
So that's a really, really good question, Carlton. We make it as seamless as we possibly can. Our ability to do tri-merge soft pulls, we're not a financial institution, so it's not going to be a hard pull. It's not like they're acquiring debt with us, but it gives us a real snapshot of where that consumer is that moment in time from a credit perspective. And then our ability through the technology piece to extrapolate the last 12 months of transactional history on a specific debit or credit card gives us all the information that we need. We don't need actually we don't need to gather any other documents. Well, from a loan perspective, we leave that up to you, your trusted processors and LOAs that you have chasing around for information. But we try to make it as seamless and painless for the consumer, because quite frankly, and I know this will be a theme through this conversation, I do not want it to be a daunting feat for a consumer to think that it's going to take climbing Mount Everest to get myself in the driver's seat of home loan readiness. And it's not. And with the back end that we have and the technology that's on the front end, it makes it very, very positive and enjoyable process for your borrower.
Now, you've mentioned a couple of times a soft pull, and we in the mortgage industry, we typically do a soft pull to start, and then we have a hard pull or a hard inquiry once we actually start the mortgage process.
Yeah.
Can you tell the difference between those two? Because that is another question we get. And usually when a hard pull, when we actually hit their credit, how many points do they usually lose? Because I get that question a lot as well.
That's probably the most misinformation out there in regards to what is a hard pull going to cost me? When does it happen? What vertical is it? What arena does a hard pull live in? So soft pull is really anything that you do online. Mortgage banks, mortgage companies like yourself have the ability to do soft pull. A hard pull is when you're acquiring debt, i.e. a mortgage, an auto loan, a credit card. That hard pull can cost you anywhere from 2 to 5 points by just that one pull. Now, I think the natural question is there a shopping window?
Yes.
There is a shopping window on the mortgage side. It's mainly through Experian, and it's only 14 days.
What? Okay.
Yeah.
But
That's definitely a lot of misinformation out there about
Yes.
I think the one thing we need to unpack is that the mortgage bank, the mortgage professional is not your enemy in regards to pulling your credit. He or she is going to need to see what's been going on the last 7 years in your lending life.
Right. And we want to make sure that we're giving them that accurate information up front as well.
Of course.
So, and especially if we need to direct them to you for them to come back to us.
Yeah, I think where people really truthfully get in trouble, Mary D, is when a consumer steps on the lot of an auto dealer.
Oh, yes.
Because there are no shopping windows. I don't care what the F&I guy tells you. I don't care what the manager tells you. That's where a consumer takes
You're just there 6 months ago.
Yeah.
18 credit inquiries or however many.
Yeah.
It's insane.
Yeah. And that's where they accumulate. And that's where your consumer sees that drop month over month.
So what you just heard here, people, is just go through your local bank. Don't go through diligence. It will massacre your credit.
Yeah.
So I have another question. So as we look at credit reports, if there are some discrepancies on there, what's the right way to take care of those?
So there is a federal law that is in place to protect the consumer against misreporting at a credit bureau level. You both, I'm sure, have heard of it. It's called the Fair Credit Reporting Act. It was from the 70s. It's still an active piece of legislation today. We leverage that through our platform that allows the consumer to contest really the accuracy, the validity of their credit report. He or she, when they're on the platform, can launch these automated disputes to make sure that everything is 100% complete, not obsolete, verifiable. So it's a really, really unique platform, again, that helps the consumer budget, that helps them rectify the credit, that helps them with DTI, that helps them with debt utilization. It is a financial wellness tool that I think it can be used by anybody because it touches so many facets, quite frankly, of the largest purchase that each and any person is going to have in a lifetime, which is a mortgage with you guys. Yeah.
That's it.
Okay, so now let's go a little off script here. So I know you got a cheat code. Tell me what's the most effective way to boost my score. Come on, I know you know, Anthony.
Yeah. That's like asking Coca-Cola the secret recipe to make soda. I think that the biggest tip I can give your clients in the pre-approval process, and let's take anything derogatory, negative off the table, is establishing credit, maintaining low credit card balances, and paying things on time. And if he or she has the opportunity to get added as an authorized user to maybe a spouse or parental unit, is something that we always advise the consumer to do as well, if the card is in good standing. Because it is true, the consumer will absorb all the goodness that that credit card comes with: a long length of history, a low credit card balance, on-time payments for 30, 60, 90 months, what have you. So it's a great way, that's the cheat code, to kind of jump on a parental unit or spouse if there's some, we call it shallow credit in our world, where there's there just might not be a lot, right? Especially now, the abundancy of credit to the first-time home buyer is a lot different than probably when I was in college in the 90s, where I'd go to my student mailbox and boom, there's a credit card and I was approved for $500 and off we went. Nowadays, it's a little trickier. So I think from a first-time home buyer perspective, if they have the opportunity to jump on a parental unit's credit card, I think it's great. I think all the parents out there, they don't need to own the credit card. They don't have to use it. They just jump on your account. If they're scared of, my child running amok with a credit card. So I think that's a really a unique way to do it as well. That gets the points really quickly and allows a consumer, first-time home buyer, to open something. We like to recommend secured credit cards. You're putting the collateral down $200-$300. There's a couple of groups that we recommend.
How long does it typically take to actually hit your score, hit your credit when you do that?
Yeah, about 4 to 6 months. So you need to make those on-time payments for 4 to 6 months. If there's an authorized user opportunity, sometimes that does speed it up. But if everything is equal, if you have a first-time home buyer that's never had any credit whatsoever, he or she opens a secured credit card, 4 to 6 months of on-time payments, you'll start seeing the benefit of that card.
How does paying off the debt versus, say, disputing the debt, how does this affect the credit report? Because something you've always heard, and of course, anytime you go on YouTube or you see advertisements, people always talking about things like credit repair and dispute this and dispute that. Now, is this misinformation or is this something that can help or hurt your credit?
100%. I think you'd be astonished with how many people get financial wellness education or information from a 30-second TikTok, from a 60-second reel on Instagram. Crazy to us because we get the calls pretty darn regularly. In regards to, paying off specific information, I'll tell the audience this, that the credit score from a derogatory perspective, I'm talking collections, is predicated on recency. How recent is an account? When was the last time it was reporting? So I'll give you an example, Carlton. I had a $1,000 bill reported from January of 2020. I pay it in full now, 5 years later. The algorithm is going to see that $0 balance now and look at it as if it's a brand new collection. So when we tell our borrowers a collection is a collection is a collection, a $10,000 collection and a $0 collection reported in the same month will adversely affect the credit score at the same exact rate.
Right.
It's not about the monetary debt. From a credit score perspective, you guys are the bank, you guys underwrite the transaction, you're going to want to know about a $10,000 collection. But again, circling back, credit being the first base of the transaction, a collection is a collection is a collection. And I think oftentimes consumers, they're doing things before they're sitting down with you guys, i.e., I'm going to start paying on outstanding debt. I want to sit down with you guys and I don't have any outstanding debt. When I say debt, I'm talking about collections. And all of a sudden, you guys both, I'm sure, pulled credit reports where it's like, oh my goodness, the score is tanked because there's a page of paid collections. But the advice in some stances should have been not to touch those collections at all.
So you mean to tell me a $10,000 collection debt versus, say, a $100 collection debt, if I pay the $10,000 collection debt down to zero, or even if I pay the $100 collection debt down to zero, regardless, you're still going to get a negative impact. So it doesn't matter about the weight of the debt. No, it's just the fact of how the algorithm reads the recency.
It was a collection.
Wow.
Yeah. So in that example, let's just say you had that $10,000 collection in 2020 and you paid it to zero today. If Mirrored equal credit, it would look like Carlton had a $0 collection for February for $0 and score would actually drop because it looks like a brand new collection in the eyes of the algorithm, which I think is crazy. I think you both know this, and maybe now you know exactly why, is when you have a client in the midst of the home buying process, when they have collections, what do you tell them to do? Stop, don't touch it, leave it alone. And that's exactly why, because everything is predicated on recency. You start paying the stuff without getting it deleted, it's just going to update the date of the last activity. That score then now will drop and compromise your consumer on the pre-approval.
Now, we've been talking a lot about the process before getting a mortgage, But what about your credit after you have your mortgage? So are there things that you can do to keep your credit healthy once you have your mortgage established? Because once it goes on the credit report, then how long does it actually take to where it becomes maybe back to a healthy level?
Yeah, that's such a great point. And I think it's where we've, quite frankly, pivoted as an organization. Ultimate goal for us is to always get the consumer in the game with you guys, get them that pre-approval. But understanding the cost of credit nowadays is vitally important to young adults, or really adults across the board, that are looking to acquire finance, because there's such a volatility in rate in regards to where a consumer is maybe at marginalized credit than someone who has perfect credit. And we've got a really powerful share that we actually give you guys at loanDepot to give your clients, where we amortize out. And that means we break down what the cost of an auto loan is at a 720 to a 620. And we do the same for a credit card, $5,000 worth of debt, things like that. I think that the biggest example that we like to give is a consumer with a 720 credit score. Let's just say I have a 720, Mary D, you have a 620. We both get the same exact car. Right. You're my next door neighbor. We each get a 5-year note, which is a 60-month term. Right. We each get a $22,000 car note. On average, with rates now in the auto industry, you're going to pay an extra $9,940 over 5 years by getting the same exact car I have. Same color, same sunroof.
Just because my score is at a 620 versus Wentworth's.
Yes. In a lot of states, your car insurance is based upon your credit score, not your driving history. So topple in another $1,000 a year extra that you'll have to pay in car insurance. For you and I to drive the same exact car for 5 years, it's going to cost you an extra $15,000. That's far too many times now, I believe, in this society. And we talk about financial freedom, and it's become a cliche. That is financial freedom. That is financial empowerment. Imagine having a household with 2 compromised credit scores, 2 auto loans. That's why the consumer doesn't have the down payment. That's why there's no closing costs. These are great people stuck in a predatory cycle where finance companies and servicers are taking advantage of consumers in a desperate state. And I'm not talking the mortgage side. I'm talking auto loans. I'm talking credit cards. I'm talking those one main accounts, those personal loans where consumers are paying back nearly double than what they borrow because they just have to be able to get by. And that's what kind of, and I'm sorry I talk so passionately about it, but the cost of credit is a problem. It's a systemic problem in the United States of America now, because people are getting stuck in these vicious cycles where they're unable to dig themselves out. And that's the exact why. Imagine paying an extra $15,000 for a car for the same exact car that we drive.
Well, it's definitely something that we talk about with our clients when it comes to the mortgage credit report, and why we would like to refer them to you so that they can go down that path. And like you had said, in regards to the journey that they would take on your platform.
Yeah. So to recap, give us 3 to-dos and 3 don'ts.
Got it. Okay. So I'm going to start with the don'ts, because this is a sneaky mistake a lot of people make. Do not close open, established accounts that you've had for a long time. Perfect example, a lot of folks that are walking around with great credit cards, with low balances and perfect payment history, they think, hey, I'm going to close my account before I sit down with Mary D or Carlton, because that's the move to make.
Got to pay it all off.
Got to pay it off and close it.
Yeah.
You lose all the payment history.
Yes.
All that payment history goes bye-bye. I'll give a really good example. I had a client of ours, actually at loanDepot out of Seattle, Washington. The consumer, he had just finished paying off his 30-year mortgage. He wanted a cosign for his dog. Pulled his credit. He was a Dave Ramsey disciple. Nothing against Dave Ramsey, but he had no credit cards open, no auto loans, and he just paid off his mortgage. Guess what his credit score was?
600.
It was NA, not available.
Yeah.
Because once he made that 360th on-time payment, he had no more trackable information.
Just eliminated that.
Exactly. And he was up in arms saying, how do I agree with him. I just made 30 years of on-time payments. You tell me now I'm
zero.
Now I'm zero. Yeah, right. So important thing is, don't close accounts, maintain low credit card balances, have 2 or 3 established trade lines, that you're making on-time payments. I think mitigate your inquiry impact. Sit down with your trusted loan officer at loanDepot. You've got unbelievable packages, unbelievable finance opportunities. You don't need to have your credit pulled 100 different ways. Don't go car shopping. Don't open up anything. Don't go get that Walmart credit card to get a washer and dryer for a house that you don't own yet, because that could throw off the DTI as well. So put yourself on a freeze. When I'm trying to get on track for the pre-approval, the name of the game is one thing and one thing only, and that's sitting down with you guys and getting that pre-approval cut. So I think those are some things that a consumer can kind of hone in on their own accord.
Fantastic.
Anthony, thank you so much for joining us today. This has been a pleasure and a lot of information, a lot of corrections, information that being in the industry for 30 years and we've heard it all, we thought, but oh my gosh, we have had such a great time today. Thank you everyone for joining us on Home School. This is our wonderful loanDepot podcast where you can get a lot of information to take you on your mortgage journey. Thank you for joining us.
See you at the next one.